Welcome to the latest Numi Save Explainer. We've got a really important mission today. The UK government just dropped two massive sets of economic data, inflation and GDP. And honestly, these numbers dictate the reality for basically every household in Britain. We're going to cut right through all the noise, figure out exactly what this means for your bills, and, most importantly, what it means for your savings. So let's jump right in.
Okay, 2.9%. That is the official UK CPI inflation rate for July 2026, and it's the highest we've seen since March. After months of really hoping we were on this nice, steady glide path downwards, well, inflation has officially changed direction. It's crept up from 2.6% in June. It's moving the wrong way. And this number right here, it's the heartbeat of our whole explainer today, because it sets the baseline for literally everything else we're going to talk about. Your wealth, your purchasing power, it all hinges on that 2.9%.
Okay, let's dive into this and look at what 2.9% actually looks like in the real world. Basically, it means the stuff you buy costs 2.9% more on average than it did exactly a year ago. So think about a weekly grocery shop that cost you £100 last August. Today, that's going to run you about 103. But the real shocker is the energy bill. A yearly bill that was £1,470 a year ago, before recent geopolitical conflicts escalated, is now capped at £1,663, and the forecasts are telling us it isn't stopping there. It's expected to jump even further to roughly £1,709 by October. So while 2.9% might sound like a tiny single-digit number when you hear it on the news, when you bring that macro data down to the micro reality of your daily life, it represents a very real, very tangible squeeze on your wallet. Now, what's super interesting is exactly why prices are behaving this way. Why the sudden jump? Well, it's almost entirely driven by energy. On July 1st, Ofgem raised the energy price cap by 13%. And because wholesale energy costs have stayed high and volatile, largely because of the conflict in the Middle East, gas prices alone skyrocketed by 14.7% in just a single month. And since energy is needed to produce, transport, and heat literally everything, that spike just bleeds right into the cost of goods across the board. But hey, there is a silver lining here. Services inflation, which covers stuff like haircuts, restaurant meals, and broadband, actually dropped from 3.6% down to 3.4%. The Bank of England watches this metric like a hawk, because a drop here means domestic, wage-driven price pressure is finally easing up a bit. Plus, core inflation, which strips out those really volatile food and energy sectors entirely, held perfectly steady at 2.6%. So underlying price pressures aren't actually speeding up. The core of the economy is holding firm. It's really just that energy spike doing all the damage. All right, moving on to the slow growth squeeze. GDP versus your wallet. 0.4%. That is the UK's GDP growth for the second quarter of 2026, spanning April to June. On an annual basis, the economy is growing at 1.2%, which is just a hair above the Office for Budget Responsibility's full-year forecast of 1.1%. So yes, technically, the economy is getting bigger. It's growing. But let's be real, it's incredibly modest. It's a slow, grinding crawl. So the big question is how this modest GDP growth actually translates to you and me. Well, consumer spending, what households are actually out there buying, grew by a tiny 0.3% in the second quarter. Why so slow? Because when prices rise faster than your income, you end up spending more money just to buy less stuff. Your nominal spending goes up, sure, but your real inflation-adjusted spending barely moves an inch. And here's the really harsh reality of how people are trying to bridge that gap. Credit card borrowing shot up 12.5% in the year to June. That is the fastest rate in over 2 years. Households are increasingly being forced to borrow just to cover their basic living costs. Because of this, default rates on credit cards have actually hit their highest level since the 29 financial crisis. Throw in the fact that 5 million UK households are projected to see their mortgage repayments go up by the end of 2028, and it paints a tough picture. The economy might be growing on paper, but for millions of adults on modest incomes, it definitely doesn't feel like a rising tide. It just feels like a squeeze. Which brings us to the next part. How to beat inflation. Your money, your move. Now, let's talk about taking back control. You can't control Ofgem's price cap. And you obviously can't control national GDP, but you absolutely can control your saving strategy. And this brilliantly illustrates the opportunity you have right now. Remember that 2.9% inflation rate we talked about at the start? To maintain the real value of your hard-earned money, your savings simply have to earn more than 2.9%. The fantastic news? This is highly achievable today. Right now, the top easy access savings account in the UK is paying 5.00% AER. Meanwhile, the top 1-year fixed bond is paying 4.85% AER. Both of these options comfortably, easily beat that 2.9% inflation rate. By moving your money here, you aren't just treading water. You're actually securing a real, tangible return on your cash. So let's turn this into a tactical decision framework for you. With the next Bank of England Monetary Policy Committee decision coming up on September 17th, you've got a choice to make: float or fix. First up, do you value flexibility? If you think you might need quick access to your cash, that 5.00% easy access rate is exceptional value. It's a fantastic return from money you might need tomorrow. But keep in mind, because it's variable, if the Bank of England eventually cuts rates, this rate will drift lower. On the flip side, do you value certainty? 1-year fixed bonds have actually fallen slightly over the last couple of weeks to 4.85%. Why? Because the markets saw that drop in services inflation we talked about earlier, and they're pricing in a lower chance of a September rate hike. If you lock in 4.85% for 1 year, or even a full 5.00% for 5 years, you're totally insulated. The risk here is that if the bank holds or unexpectedly raises rates in September, you might miss out on slightly higher variable rates. But if they cut rates, you're safely locked in. For money you know you won't need to touch for a while, securing that certainty right now is a highly rational move. Which brings us to our final thought for today. The data is super clear. Inflation is sitting at 2.9%, mostly driven by energy costs. The broader economy is crawling and everyday incomes are feeling the squeeze. But you have a clear way out. With a top easy access rate of 5.00%, you actually have the opportunity to capture a real return of roughly 2.1 percentage points above current inflation. That is incredibly meaningful for your financial health, but it requires you to actually take action and move your money to a competitive account. So I'll leave you with this. Your savings need to be 2.9% just to survive. Take a look at your accounts today. Is your money working hard enough?